Welcome to The Explainer. Let's talk about building wealth. We've all heard about those notorious financial mistakes that keep people completely broke, right? Things like taking on toxic bad debt or constantly chasing appearances just to look rich. Well, let's say you're smart, you avoid all that, you do the responsible thing, and you start saving. Every single month, you diligently funnel a little bit of your paycheck, maybe $100 here, $200 there, straight into your savings account. And honestly, it feels great. You feel disciplined, financially mature, like you're doing exactly what we've all been taught since we got our very first piggy bank. But as we're going to see today, that cozy feeling of financial security might actually be masking a much bigger problem.
Because here's where the trouble really starts. One day, you open your banking app on your phone and you realize something kind of strange. You've done the hard work, you've scraped together the cash, and boom, your savings account finally hits $10,000. 10 grand sitting right there. But then you look a little closer at the actual interest you're earning on that money. It's usually something tiny, right? Like 0.5%. Meanwhile, everywhere you look, people are talking about investing, stocks, index funds, and compound growth. Suddenly, that immense pride you felt turns into this nagging question. Wait, is doing the right thing actually holding me back? Am I doing this entirely wrong?
Well, let's look at the harsh mathematical reality of that 0.5% interest. If you leave your hard-earned $10,000 in a standard savings account for a full year, your grand total profit is a measly $50. Yeah, $50 for an entire year of strict financial discipline. I mean, that barely covers a decent dinner out these days. Look, saving money is obviously a fantastic habit, but saving alone will almost never build you real wealth. And this is exactly where so many of us get stuck. We know saving is absolutely critical, but we have literally no idea how to safely transition that cash into actual wealth-generating investments. A huge insight from our sources is understanding that money actually has different jobs depending on where you put it. Saving isn't the finish line, it's just stage one. As this comparison shows, savings exist to protect your money, while investments exist to grow your money. Those are two radically different jobs. If you expect your standard savings account to make you wealthy, you're essentially asking it to do a job it was literally never designed for. It turns out just piling cash into a bank account isn't the final destination. Section 1, the math of missing out and the cost of playing it safe. The sources make a fascinating point. The biggest wealth gap out there isn't actually between savers and spenders, it's between savers and investors. And this brilliantly illustrates exactly what that means. Let's compare two paths for that same $10,000 over a 20-year period. Up top, if you leave it in savings earning a generous 1%, after 2 decades, you end up with about $12,200. But check out the bottom row. Historically, the S&P 500 stock market has returned an average of around 10% per year over long stretches. If your 10 grand earn that 10% annually, in 20 years, it skyrockets to roughly $67,000. That's the exact same starting money, but a totally different life-changing outcome, all thanks to the absolute magic of compounding over time.
Section 2, the psychological barrier. Why investing feels risky.
So why do so many people fall into the trap? The massive financial mistake of being terrified to invest. It's not because they can't do the math. It's human psychology. Saving feels safe, while the emotional roller coaster of investing feels, well, terrifying. When your money sits in a savings account, it never randomly drops 5% on a Tuesday afternoon. But think of it through this vivid analogy. Saving money is exactly like storing seeds in a glass jar on your shelf. You're perfectly protecting them from the elements, but absolutely nothing is going to grow in there. Investing, on the other hand, is like taking those seeds and planting them out in the soil. At first, it's messy. You've got to deal with rain, mud, and storms, and you definitely don't see results right away. But over time, you have to endure that temporary discomfort if you ever want to see massive, towering growth. Section 3, the 5-step transition plan. Becoming an investor safely. Now, you might be thinking, okay, but I really don't want to lose the savings I worked so incredibly hard for. That is completely fair, and that's exactly why this transition shouldn't happen blindly. Here is the roadmap straight from the sources. First, build an emergency fund. Second, establish separate mental buckets. Third, start investing small. Fourth, focus on simple investments. And fifth, stay disciplined. Let's dive right into step 1.
Step 1 is absolutely non-negotiable. Build a real emergency fund. Before you put a single dime into the market, you need 3 to 6 months of basic living expenses saved up in cash. And this money stays in your savings account. It's not for investing, it's for when life happens, a job loss, a medical emergency, a sudden car repair. What most people don't realize is that the biggest reason beginners panic sell their investments at a massive loss is simply because they need the cash too soon. A solid emergency fund actually protects your investments from your own life.
All right, once your emergency fund is locked in, step 2 is all about mental framing. The sources suggest mentally separating your money into 2 distinct buckets. Bucket 1 is your safety money. This is your emergency fund. It does not move, it does not drop, it just gives you pure peace of mind. Bucket 2 is your growth money. Because your basic survival is already protected by Bucket 1, you can mentally allow Bucket 2 to fluctuate. You literally expect it to go up and down because its only job is to grow over the long haul. This simple mental trick dramatically reduces financial anxiety.
Moving on to step 3, start investing small. A huge myth that keeps people totally frozen is this idea that you need thousands of spare dollars to start investing. You really don't. Plenty of modern platforms let you start with just $50 or $100. When you're first making this transition, your goal isn't massive early profits, and you definitely don't need to perfectly time the market. Your only goal right now is building the habit, because in the wealth building game, consistent habits matter way more than perfect timing.
Step 4 is where beginners so often mess up. You really need to focus on simple investments first. People scroll through social media and think they need to jump straight into day trading, crazy options, or crypto speculation. That is a classic mistake. Simple strategies almost always outperform complicated ones. Enter index funds. An index fund simply tracks the overall stock market. So instead of stressing out trying to pick one magical winning company, you're instantly investing in hundreds of companies all at once. It's diversified, it's significantly lower risk, and it historically delivers very steady long-term growth.
Now, if you're sitting there thinking index funds sound a little too boring to actually make you rich, consider this. Legendary investor Warren Buffett has repeatedly recommended low-cost index funds for most everyday investors. I mean, when one of the wealthiest, most successful investors in human history tells you that a simple, boring strategy is the best way to grow your money, it really pays to listen. The most powerful investing strategy isn't flashy, it is just incredibly consistent.
And seeing that consistency in action is wild. Which brings us to step 5, staying disciplined. Let's say you invest just $300 a month into the stock market. If it averages an 8% return, after 25 years, you'd have roughly $285,000. But check out this chart. The smaller slice, that's your personal contributions, just $90,000 out of your own pocket. The massive slice, nearly $195,000, is purely compound growth. The market literally generated more than double what you actually put in. That is compounding working its magic, provided you stay disciplined.
Section 4, surviving inevitable market crashes by thinking in decades, not days. Okay, we gotta address the elephant in the room. What if I start doing all this and tomorrow the market completely crashes? Well, market drops are totally normal. They've happened dozens of times throughout history. When headlines get scary and amateur investors panic and sell, the experienced long-term investors just stay calm. Why? Because market crashes actually allow your consistent monthly investments to buy more shares at much lower prices. It's exactly like your favorite store throwing a massive clearance sale. By buying cheaper shares during a downturn, you're setting yourself up for significantly stronger returns when the market eventually bounces back.
So, let's bring this all together. By avoiding those common financial mistakes that keep people broke, like bad debt, chasing appearances, and letting the fear of the stock market paralyze you, you can leverage 2 incredible tools. Saving money gives you stability. It lets you sleep at night knowing your basics and emergencies are fully covered. But investing gives you freedom. It puts your money to work so that one day you simply don't have to. The earlier you can safely combine both stages, the more unbelievably powerful your financial future becomes.
Which leaves us with one final, pretty important thought. Take a hard look at your own finances right now. Be completely honest with yourself. Are you currently stuck in the saving stage, just hoarding seeds in a jar? Or have you already started making the transition into the investing stage, actually planting those seeds in the soil? Wherever you're at, you now have the exact blueprint to take your next step. Thank you so much for joining me for this explainer, and I highly encourage you to take that very first step today.